Welcome to The Explainer. Today, we're diving straight into a topic that's incredibly relevant for a lot of Aussies mapping out their retirement. We are talking about self-managed superannuation funds, or SMSFs. You've probably heard people say that an SMSF gives you more control, but we're going to unpack what that actually means and why that control goes hand in hand with a whole lot more responsibility. To get us started, I want you to picture a typical Sunday afternoon. Let's introduce Sophie and Liam. They're an everyday Australian couple sitting at their kitchen table trying to organise some ideas for their future. They've got a couple of coffees, the laptop's open, and they're watching a few educational videos on financial planning.
So in one of these videos, the presenter casually drops this line, "With an SMSF, you get more control." Well, Liam hears this and immediately reacts. He leans over to the screen and says, "More control? That sounds pretty good." That's a completely natural reaction. For so many of us, the idea of finally sitting in the driver's seat of our own wealth accumulation sounds absolutely brilliant.
But Sophie, who's definitely the analytical one of the two, looks right at him and asks, "But control over what exactly?" Liam kind of shrugs and replies, "I'm not really sure. I guess it means you can manage more things yourself?" Sophie pauses for a second and says, "Because there's a big difference between being more involved and assuming you can just use the money whenever it suits you." And honestly, Sophie hits the nail right on the head here. That is a massive distinction, and it goes straight to the core of how superannuation laws actually work in Australia. This brings us to a really common myth. A lot of people think more control means complete freedom. They think their super fund suddenly transforms into an everyday piggy bank. But the reality is strictly grounded in the Superannuation Industry Supervision Act, or the SIS Act. When we talk about control, we are actually talking about having active involvement in long-term investment decisions. An SMSF is still fundamentally a super fund. That money is locked away strictly for your retirement. You definitely cannot use it to buy a new family car or pay for a trip to Bali today. So what does more control actually look like in the real world? Well, it boils down to practical flexibility. It means you are the one formulating the fund's investment strategy. You determine exactly what asset classes to hold, whether you're looking at direct shares, term deposits, or property. You are the one responsible for monitoring how those investments perform over time and eventually managing how those assets fund your retirement income. You're analyzing the market and making the strategic choices yourself rather than just ticking a box for a preset option in a large retail or industry fund. Let's jump back to our couple at the kitchen table. A bit later that afternoon, while he's up making another coffee, Liam adds, "Now I'm curious, when people say more control, are they also talking about more responsibility?" Liam's genuine curiosity here perfectly pivots our conversation towards the everyday realities of running one of these funds. Because the short answer, absolutely yes. You literally cannot have all that strategic control without taking on the legal and administrative weight that comes with it. The key to truly understanding this responsibility comes straight down to the structure of the fund. Under Australian law, an SMSF can have up to 6 members. But here is the foundational rule. The golden key to the whole operation: every single member must also take on the role of a trustee or a director of a corporate trustee. You don't get to just be a passive passenger in an SMSF. Legally speaking, you are running the show. Now, what exactly is a trustee? Simply put, it's the person or entity legally responsible for managing the trust property strictly for the benefit of the members. And remember that SIS Act we mentioned? It acts as the ultimate rulebook here, and it places the final legal responsibility squarely on your shoulders. Even if you go out and hire a fantastic accountant or a financial advisor to help you out, as the trustee, you're still the one signing off. You are the one the Australian Taxation Office, the ATO, holds accountable. So let's look at what that responsibility actually looks like day to day, because it is definitely not a set and forget situation. Think about the paperwork for a second. You are required to document all fund transactions. You literally need to maintain formal meeting minutes for the investment decisions you make. You've got to retain these records for anywhere from 5 to 10 years. On top of that, you must arrange for an independent, approved SMSF auditor to review your fund every single year, and you have to accurately report all your assets at their true market value. It takes time, it takes continuous education, and it requires your active attention. Now, amidst all these rules, regulations, and administrative tasks, there's one ultimate safeguard built right into the legislation. It's essentially the overarching guiding light for every single decision you make as a trustee, and it's there to ensure that people don't misuse the control they've been given over their super. We call it the sole purpose test. It means the fund must be maintained strictly to pay retirement or death benefits to members or their dependents. Full stop. The ATO monitors this incredibly closely, using SMSF assets to gain a present-day personal benefit, say buying a holiday house through your SMSF and staying in it yourself over the summer, or buying a nice piece of artwork to hang in your own living room, is a strict contravention of the law. Every single investment has to be for your retirement, not for your current lifestyle.
So why is staying on top of all these rules so absolutely crucial? Well, the stakes are very real. When you play by the rules, your fund is classified as a complying fund. That means it's eligible for standard superannuation tax concessions, which are generally very favorable here in Australia. But if you severely breach the rules, the ATO can declare your SMSF a non-complying fund. If that happens, the fund's assets and income can be taxed heavily at the highest marginal rate, which is 45%. And that can absolutely devastate your hard-earned retirement savings.
But let's take a breath, because it's important to understand how the ATO actually operates as a regulator. They aren't just hiding in the bushes waiting to instantly punish people. Often, they act as an educator first. For minor breaches caused by genuine misunderstanding, they might just issue an education direction, which means you have to take a course to get your knowledge up to scratch. However, for more serious or repeated breaches, they can and will apply personal administrative monetary penalties. And here's the kicker. You have to pay those out of your own pocket, not from the super fund. In the most severe cases, they issue that notice of noncompliance, or they might even freeze the fund's assets entirely. Bringing it all back to Liam and Sophie's Sunday afternoon chat, an SMSF can be a phenomenally powerful vehicle for the right person, but it demands a true balance. You get that active investment control, sure, but in exchange, you have to embrace strict, ongoing legal compliance. It requires continuous education, a real dedication of your time, and a healthy respect for the rules that govern the Australian retirement system. So the big question you have to ask yourself is, are you ready to take the wheel, or is the administrative weight just a bit too much luggage for your retirement journey?
Thanks so much for joining me for this explainer. I really hope it's brought some clarity to the reality of running a self-managed super fund. To wrap things up today, this content is general and educational. It is not financial advice. If you already have an SMSF or want to better understand your compliance responsibilities, speak with the team at Wendy Super Accounting.